Slammed in a steep sell-off on fears of China slowing growth, but it might not all be China's fault. Mike Ozanian says the markets are taking a hit because profits are down. And Mike, stocks were just expensive, were they not?
Oh, absolutely. 17 times earnings, the high end of where they are historically. But as you and I both know, Dagen, because we've talked about this a lot over the years, corporate profits are the mother's milk of stock prices. And if you look at the past 2 quarters through the first quarter of this year, the corporate profit number by the Fed, in other words, they look at all the national income accounts, all the big, small, medium companies that report profits, they're actually down for 2 quarters. It's the first time this has happened on a pre-tax basis since 2008. And to me, this is a harbinger of lower corporate profits in the future, and even worse, lower take-home pay.
So there are so many signs there, right, Mike, that we were in store for a market pullback. But I think what shocked people was the kind of fear got away from us. You saw the VIX had its biggest weekly gain in its history last week, that the sell-off was so swift and so violent. And I want to know what you think about the cause might be of that. Like, why now? Why did we see such a violent reaction on the downside last week, but really just this morning?
Well, I think what's come home to roost, Dagen, is this misplaced conception that money printing by central banks around the globe would create more wealth and create economic growth. It's completely failed. Doesn't matter whether you're looking at Japan, China, the Eurozone, or the United States. None of these economies are in good shape right now. And what these people fail to understand, who want the Fed to keep interest rates low and keep currency values low, is that the genesis of economic growth isn't low interest rates or more consumer spending. It's investment in plant and equipment. It's the accumulation of capital into businesses that will then supply jobs and higher income. And that's why this recovery has been the worst since the 30s, is it's been very, very punk on the investment side in plant and equipment.
But as soon as you see a market drop, people are crying that the Fed, including Larry Summers, you can't raise interest rates here. You can't raise interest rates here. And we can only continue. How long can we continue to use hooch to cure the hangover?
Well, and actually that hooch you're talking about is the reason why we've had such a big hangover.
Right.
With all due respect to Mr. Summers, he is wrong. Devaluing your currency does not make you richer. It makes you poorer by definition. And what we need to do right now is slowly but surely increase interest rates so that the dollar can be stable. It's not so much whether it has big swings on the upside or the downside as it is that it needs to be stable so investors know what the speed limit is and that their future investments aren't going to be worth less. That's very important. And a rise in real interest rates, Dagen, does not necessarily mean stock prices are going to go down. In fact, they may actually go up on such news.
Yeah, but you've seen the ECB raised rates and had to pull back. John Hilsenworth was talking about the people at the Fed are studying Sweden because they did the same thing. Do you believe truly that this Federal Reserve going into an election year would raise rates and continue raising rates?
No, I don't. I think they continue to put poison into the financial markets because I think that they believe, despite what history has taught us, and if you go back to the Kennedy recovery with lower marginal tax rates and a stable dollar, or the great Reagan recovery where you had a stable dollar and you saw real interest rates go up,
right. And
those recoveries were powerful and long-lasting. For some reason, they don't believe that. They think you have to devalue your currency and print money, and that's how you create wealth, when in fact, the world economies are telling us the exact opposite.
Right. And we're all addicted. Mike, thank you so much. Mike Ozanian with Forbes.